Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. If you've been following the channel, you'll know that I've posted a number of videos recently raising concerns about the slowdown that's being seen in China. And we've now got more data that confirms that that slowdown is accelerating. The total volume of China's exports fell by 7.5% in May, which was significantly higher than market expectations, and is further cause for concern both for the Chinese economy and also for the global economy. So in today's video, we'll have a look at what's happening with China's exports and imports. We'll have a look at the other data that's so far been released in May. We'll talk about the devastating impact of the heavy rains that China has been experiencing recently, which is decimating the much-needed wheat harvest and means that China will now start having to import large amounts of wheat. I'll give you an update on the ongoing technology war between China and the USA. In response to the USA banning a variety of Chinese businesses, China have now retaliated and banned one of the major US chip companies. We'll have a look at the current position with regards to inflation and interest rates in some of the key economies. And then finally today I'll wrap up with my summary as to what I think is likely to happen in both China and the global economy over the course of the next 3 to 6 months.
Chinese exports tumbled in May. Figures out Wednesday showed overseas shipments slumping 7.5% on the year. That was many times the forecast fall of just 0.4%. The numbers were worse even than when the port of Shanghai was closed due to lockdowns a year earlier. Factory output has slowed as overseas demand weakens. Consumers and businesses in the US and Europe are being squeezed by rising inflation and interest rates. Now the slowdown raises questions about the durability of China's own recovery. The world's second largest economy grew faster than expected in the first quarter. It was helped by a recovery in services and a backlog of orders after years of disruption due to the global health crisis. But other data has already indicated that the rebound could be sputtering. Numbers from South Korea last week showed its exports to China down by more than a fifth, indicating demand was falling away. One economist told Reuters the trade slowdown will ramp up pressure on Beijing to boost domestic demand. Many now expect to see fresh stimulus measures.
This chart shows the year-on-year movement in both imports and exports for China dating back to April 2021. The dark blue line plots the movement in imports and the light blue line the movement in exports. Now if we start with the exports first, as you've just seen, the total value of China's exports fell by 7.5% in May. And for an economy like China, which is a net exporter, that is extremely bad news. So in isolation, the 7.5% fall is obviously negative. But if we take a step back and look at the overall trend over the last 2 years, you can see that this graph is trending very much downwards. Back in April 21, the year-on-year growth in exports was around 30%. However, in the following 12 months, the growth in the value of exports started to decline, and by April 2022 was running at less than 5%. The value of exports then bounced back in May, June and July, and the year-on-year growth got back up towards 20%. However, that growth started to falter in September and October, and in November and December it moved into negative territory. The total value of exports started to fall. That fall continued in January when the year-on-year fall got to around 10%. We then saw a bounce back in February and March, and everybody at that time was talking about the fact that the Chinese economy had recovered, it had turned the corner, and was now looking at strong year-on-year growth for the rest of 2023. However, the year-on-year growth unexpectedly fell in April, and the contraction in the level of China's trade has continued into May. And for an economy like China, which is a net exporter and is dependent on exports for a high percentage of its GDP, a 7.5% fall year on year is a disastrous result. Now, in terms of assessing whether or not this is a short-term blip or something that has longer-lasting consequences, we need to look at the level of imports, because China imports a lot of raw materials, which it then uses in its manufacturing processes in order to create the goods and products for export. So if we look at what's been happening to imports over the last 2 years, you can see that the overall trend is also negative. It moves almost in parallel with the level of exports. Back in April 2021, the year-on-year movement in imports was up by more than 40%. It then rose to more than 50% in May. However, since that time, the level of growth of imports has reduced dramatically. Between March and October, we saw 0% growth in the level of imports. However, in November, December and January, we actually saw a year-on-year decline in the value of imports, and the reduction in January was in excess of 20%. There was a short-term bounce back in February when we saw the value of imports rising slightly. However, in March, April and May, the total value of imports has fallen year on year. And this represents really bad news for China, because if it's importing less raw materials, that means that it won't be able to produce as much, and that will have a negative impact on the value of its exports. So the overall fall in the value of imports that's been seen since November is now likely to drag down the value of exports and will therefore have a further detrimental impact on the level of trade that China is completing. This chart plots the Purchasing Managers Index over the last 18 months for both the manufacturing sector, which is shown by the red line, and the non-manufacturing sector shown by the blue line. And if we look at the manufacturing sector first, you can see that during 2022, the index was at or below the critical 50 mark, which means that the industry was really struggling to deliver any positive outlook in terms of growth. And this was really linked to the zero tolerance policy that was still being implemented in China with regards to COVID-19. So China was still locking down tens of millions of people on a regular basis, and that was having a direct negative impact on manufacturing. However, those restrictions were finally moved at the end of 2022, and as a result of that, we saw the PMI index cross over the 50-point level, and in February 2023, the outlook was very positive for China. However, as you can see from the graph, that positivity has been very short-lived, and it will be very interesting to see over the course of the next few months if we see a continuation of the downward trend in terms of the PMI index, or if China can manage to turn things around and bring it back above the 50 level. And if we now have a look at what's happened in the non-manufacturing sector, you can see that it's followed a similar trend. However, the levels have actually been much more pronounced. So in the first half of 2022, we saw a major fall in the non-manufacturing PMI to around 42. We then saw the index bounce back to a level of around 55 in the middle of 22. However, by the end of the year, it was back down around 42. At the start of 2023, we've seen the index bouncing back again to a level of around 57. However, over the last couple of months, we've seen that coming back down, and it's now sitting at around 54.5. So both of these indexes are following a similar trend, and the concerns right now is that they're on a downward trajectory. This chart shows the year-on-year percentage movement in inflation in China over the last 18 months. And we've got two different indices shown here. The red line shows the CPI, which is the Consumer Price Index. So that's basically prices that are paid in stores and online by consumers, so you and I. And the blue line shows the Purchasers Price Index, which is also referred to as factory gate prices. So this is the price of finished goods that are leaving factories in China. So as you can see from the red line, China has not been suffering from the high levels of inflation that have been seen all around the world over the course of the last 18 months. At the start of 2022, inflation was running at less than 2%. There was some growth during the first half of 2022. However, by the end of the year, inflation was back down to around 2%. And in 2023, those inflation levels have been falling, and the current annual rate of inflation is now at 0.1%. So basically, there has been no movement in prices over the course of the last 12 months in China. And if we now look at what's been happening to factory gate prices, at the start of 2022, factory gate prices were increasing by around 10% year on year. However, during the course of that year, there was a huge reduction in that rate. And by the end of 2022, factory gate prices were actually falling year on year. They dropped into negative territory. And that trend has continued throughout 2023. And currently, the annual rate of inflation for factory gate prices is a fall of 3.6%. Now, for anybody that's watching this who's had to live with high levels of inflation over the course of the last 18 months, you may be thinking that this represents good news, because if prices are coming down, then that means that you're going to have more money in your pocket. But when factory gate prices are falling, it's bad news for industry, because over the course of the last 18 months, we have seen global costs rising. The price of oil and gas and food and a whole host of other commodities rose dramatically during the first half of 2022, and those prices have remained relatively high when you compare them to where they've been sitting over the course of the last 5 years. So the problem that Chinese industry is now facing is that its costs are rising, but its factory gate prices are falling. So Chinese companies are currently selling their finished products for 3.6% less than they were this time last year. However, if you've had an increase in costs during that period, what that means is that you're having to absorb all of those cost increases yourself, and therefore you're making less profit.
This Chinese farmer says his battered wheat is not even worth harvesting anymore. He's one of many farmers now struggling in the country's central Henan province after weeks of heavy rains.
The wheat harvest, the weather is not giving us a good harvest. Farmers are working very hard this year. All the wheat crops have sprouted. People are also very anxious.
Henan produces around a third of the country's wheat. The unusually heavy rains are causing the wheat to sprout early, often producing lower quality flour unfit for humans. At the same time, the rains are delaying the harvest. Compared with 90% this time last year, state media reported only 3/4 of Henan's crop had been harvested. According to farmer Chen, there's also a shortage of machinery needed for the harvest.
We have harvesters with caterpillar treads, but there are not many around. And because it is such a big area here, it is not possible to harvest everything. The main reason for this is that the weather is bad, and even after those harvesters, wheat crops will not dry out completely. It will inevitably be rotten. We might as well not harvest at all.
The rains have also impacted neighboring provinces like Anhui, Shaanxi, and Shandong. The government has urged, quote, extraordinary measures to address the crisis and has ordered state grain buyers to purchase lower quality wheat at above market prices.
Imports of wheat into China are already going up.
To make up for the loss, Darren Friedrichs of a consulting firm based in Shanghai says China, the world's largest wheat consumer, may have to bump up grain imports.
So that would obviously have an impact on global prices and an impact on global markets.
That potential bump in China's wheat import would come as the El Niño weather pattern is set to sharply reduce wheat output this year in Australia, another major producer.
China says a major US chipmaker, Micron Technology, failed a review and poses a national security risk. It announced on Sunday that it was banning them from being used in key infrastructure projects. The move appears to be an escalation of tension over technology and trade between Beijing and Washington. It follows a weeks-long review into Micron by China's cyberspace regulator and could affect everything from transport to telecoms to finance. In a statement, the CAC said it had concluded that Micron, quote, pose significant security risks to China's critical information infrastructure supply chain. The CAC did not provide details on what risks it had found, nor what Micron products would be affected. Within hours, the US Commerce Department said the ban had no basis in fact. Micron gets about 10% of its revenue from China, but it's not clear if the company's sales to non-Chinese customers in the country will be affected. In its own statement, Micron said it had received the CAC's notice and it looks forward to continuing to engage in discussions with Chinese authorities. That same day, US President Joe Biden said they had agreed to de-risk and diversify our relationship with China. The US has already imposed a series of export controls on chip-making technology to China and moved to prevent Micron rival Yanxi Memory Technologies from buying certain American components. Sunday's news helped boost stocks of Micron's rivals like South Korea's Samsung, which are seen as benefiting if mainland firms seek memory chips elsewhere.
Now, obviously, the main focus of today's video is to talk about what's happening in the Chinese economy. However, what happens in China has a major influence on what happens in the global economy, because China is the second largest economy in the world and it's the world's manufacturer. It's making a lot of goods that are then bought by other countries. And one of the reasons that the Chinese economy is struggling right now is that global demand is falling. And I wanted to provide you with a quick update as to what's happening with inflation, because inflation has been one of the biggest topics on the economic agenda over the course of the last 2 years. As we came out of the COVID-19 pandemic towards the end of 2020, we saw a surge in global demand, which pushed up prices and drove up inflation. And that situation was accentuated after Russia's invasion of Ukraine, when we saw a spike in commodity prices such as oil, gas, and wheat. And high levels of inflation are generally bad news for an economy, and central banks around the world have been trying to bring back inflation by increasing interest rates. So I wanted to have a quick health check as to where we are right now with regards to inflation. And this chart shows the latest inflation figures for the G20, which are broadly speaking the largest 20 economies in the world. Now, if you follow the channel, you'll be up to date as to what's happening with regards to Argentina and Turkey, both of which are having economic crises right now. And the rate of inflation in Argentina is currently running at 109%, and Turkey is coming in just under 40%. So those two are completely off the scale compared to all of the other countries in the G20. But if we now move on to the country with the third highest rate of inflation, which is the United Kingdom, inflation is currently at 8.7%. And that represents a major problem for the UK because the target rate of interest as set by the government is 2%. So the current rate is more than 4 times higher than where the economy wants to be. So what that means is that the United Kingdom is going to keep increasing its interest rates until inflation gets down to around 2%. And if we have a look at this chart, which plots the official rate of interest in the UK back to the start of 2022, you can see that there's been multiple interest rate increases over the course of the last 15 months. At the start of 2022, interest rates were running at virtually zero. However, today they're sitting at 4.5%. And as I just mentioned, inflation is not at the target rate. So what that means is that interest rates will continue to increase. And there are 2 reasons why this is really bad news for the UK economy. Firstly, increased interest rates mean an increase in the cost of borrowing. And in the UK, a lot of companies and also a lot of private individuals have floating rates of interest. So that means that when interest rates go up, so does the cost of their debt. So the increase in borrowing costs doesn't just affect new borrowers, it affects a large percentage of the population. So that's obviously bad news. But the other factor here is the rate of these increases. The fact that the UK has been introducing interest rate rises almost on a monthly basis for the last 15 months means that the full impact of these rises hasn't really fed through into the economy because it takes 6 to 9 months to feed through. So when you're constantly raising interest rates, that means that there's going to be a future impact in 6 or 9 months' time. So although it feels like inflation is old news and we've got over that problem because inflation has started to come back down, inflation of 8.7% means that prices are up almost 9% against this time last year. Now the trend is that the growth is slowing down, but prices are still going up. And until inflation gets down to that target level, interest rates will keep going up, and that's going to cause more pain for the economy and push the UK closer to a recession. The next country on the list is Italy, where inflation is currently running at 7.6%, which is down compared with 8.2% from the previous month, but is still significantly above the target rate of 2%. Now, Italy is part of the European Union and is party to the collective interest rate policy operated by the EU. And this chart shows the movement in interest rates in the EU dating back to the start of 2022. And this shows that in July 2022, interest rates were sitting at around 0%. However, since that time, there has been consistent increases in the rate of interest, up to the current level of 3.75%. And the same principles that we just talked about for the UK apply to all of the European countries, because we've seen a rapid increase in interest rates, and that will take time to feed through into all of those economies. It will have a negative impact on the growth of those economies. The next country on the list is Australia, where inflation is now running at 7%. And as with Italy and the UK, this represents a fall from the previous month. However, it is still significantly above the target rate of inflation of between 2 and 3%. And if we have a look at what's been happening to interest rates in Australia, it's exactly the same trend as we saw for the UK and the Eurozone. There have been a lot of rapid increases in interest rates over the course of the last 12 months. And those increases in interest rates will take time to feed through fully into the economy. So Australia is also facing the double problem of firstly not being at its target rate of inflation, so that indicates that more interest rate rises are likely to come. And secondly, the full impact of the rate rises that have been introduced over the last 12 months has not fed through into the economy, so that will apply downward pressure to the Australian economy. And if we look at the other countries on this list, the target rate of inflation for the vast majority of these countries is 2%. So the current rates of inflation are way above where they want to be. South Africa's at 6.8, Mexico 6.25, the whole of the euro area 6.1%, Singapore 5.7%. Now if we move on to the United States, you can see that the current rate of inflation is sitting at 4.9%, which is virtually the same level as it was the previous month. Now, the target rate of inflation in the USA is also around 2%. So a rate of 4.9% is significantly higher than where the Fed wants it to be. And as a result of that, it's likely that the Fed will continue to increase interest rates. And if we have a look at the chart as to what's been happening over the course of the last 15 months, you can see that there have been multiple interest rate increases already, and they've been coming through almost on a monthly basis. And as we've discussed, it will take time for the full impact of those interest rate increases to feed through into the US economy. And to emphasize that point, let's have a look at what's happening in Canada. The most recent rate of inflation is 4.4%, which is lower than a lot of other countries on this list. However, it represents an increase in inflation compared to the previous month, and also is more than double the target rate of 2%. And as a result of that, the Canadian Central Bank unexpectedly increased interest rates to 4.75% in June. So this really proves that central banks are committed to bringing inflation down to their target rates, and that interest rates will continue to be increased until that happens. So the overall summary of this analysis is that it's extremely likely that we will see a continuation of increasing interest rates, which will have a negative impact on the individual economies that we're looking at here, but collectively will have a negative impact on the global economy. So what's the summary and conclusion today? Well, I wanted to post this video to give you the latest data coming out of China, and that data tells us that things are not going well. The level of exports has fallen by 7.5% in May, and for a country like China, which is entirely dependent on exports for the growth of its economy, that represents really bad news. And over the last few months, we've seen a big fall in the level of imports, and that's going to be bad news over the next 3 to 6 months, because China imports lots of raw materials, which it then processes and exports as manufactured goods. So if it's importing lower quantities of raw materials, that means that it's likely that it will be exporting less as well. So from a trade perspective, the outlook for the rest of 2023 is negative for China. And to add more fuel to the fire, China and the USA are now in the midst of a technology war. The USA has banned a variety of Chinese companies from gaining access to US technology, and in response to that, China is now introducing its own bans. And overall, that has to be bad news for the global economy, because the global economy works best when everybody's working together, when you share technology and we can all move forward. Once relationships start breaking down for whatever reason, that will have a negative impact on the growth of individual businesses, national economies, and the global economy. And that's exactly what we're seeing right now. And unfortunately for China, the weather is also working against them at the moment. The heavy rains that have been experienced in certain parts of China have had a negative impact on the wheat crops. And wheat is fundamentally essential to the food chain in China. It's the raw material that's used to make noodles and bread and pasta. That means that China will now have to start importing more wheat. That's likely to increase the global price of wheat because there's more demand for it, and that will fuel inflation further all across the world. And unfortunately for the global economy, inflation remains a major problem. The vast majority of developed countries in the world still have a problem with inflation, and that means that interest rates are likely to continue rising, and increasing interest rates are bad news for the growth of your economy. So we've got a situation here where China is already slowing down, but the vast majority of the economies that are China's buyers are struggling with high inflation and therefore are having to increase interest rates and cause slowdowns in their own economy. And until the inflation problem is put to bed once and for all, it's likely that we will see continued slowdowns in those economies and therefore a continued slowdown in the global economy. So the overall summary of today's video is that things are not going well in the Chinese economy, but unfortunately that's having a knock-on impact to the global economy, and the likelihood of a global recession happening at some point in the next 6 months is now rising. So I'll keep you posted on any further news and developments as and when they happen. Hopefully you've enjoyed today's video, found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.